Am I saying they won't cut in February? Not necessarily, but it's certainly not a penalty kick if you look at how close things are. We'll, of course, by then had another couple of months, at least another month anyway, of macro figures, aside from anything else, because the Fed meeting is very, very early Feb. What about the forecast revision then? Well, we can expect the bank to bring forward its projection for when it's going to reach the 2% target. They were expecting it in 2027 for inflation, but the 3.2% print suggests we could hit 2% by quarter 2 2026. Still sounds a bit over enthusiastic to me. Everyone's looking at April as this huge deflationary month this time round, just simply because they've frozen a few train tickets and they've got this 150 quid off energy bills. We're still going to have minimum wage impact pushing prices upwards. We're still going to have council tax rising at nearly 5%, I'm sure, again, across the country. It's not clear to me it'll be this gigantic deflationary month, but let's see what happens. The credibility gap then. The open letter triggered by the October 3.6% print highlights the volatility. The bank is oscillating between explaining why inflation is too high and justifying why they're cutting rates. February's report will likely focus heavily on scenario planning to mask the lack of conviction in the central forecast. They don't want to create this expectation disconnect, right? Because if you don't know what's going on, you would look at it and go, well, inflation's 3.2, but rates are coming down. I thought rates went up, and this is the same, it's not the same reasoning, but it's similar to what happened around times when the bank were hiking rates, and people were saying, well, it won't fix inflation in terms of energy prices around the world and things like that. Largely speaking, the uninitiated miss the point, right?